Ladies and gentlemen, thank you for joining us today and welcome to our firm's Investing in India program for the seventh webinar in this series. My name is Purti Minawala and I'm a partner in Khetan's corporate practice group. I would like to extend a very warm welcome to every one of you, wherever you are around the world. Investing in India is a webinar program curated specially for existing and prospective foreign investors in India and their advisors to enhance understanding of key issues in doing business in India. The program seeks to cover all time issues of interest to our target audience. In today's session, we will be examining the overview of the exchange control regulations and the key principles. Well, as they say, an optimist sees the glass half full, a pessimist sees it half empty. But a seasoned India lawyer sees it and asks, has this transaction been reported to the RBI in Form FCGPR within 30 days? With that, on this slide is the agenda for today's program. If you do have questions, please submit them using the facility provided in the webinar portal. If we do not cover questions during the webinar, we will respond offline by email after the webinar. Also, please note that a copy of the presentation, summary notes, and a recording of this webinar will be sent to you right after the webinar as a matter of course. Let me now introduce you to our speaker for today. All registered participants should have already received an email with the resume of our speaker and myself. So I will keep the introductions brief. Our presenter today is Moin Ladha, who is a partner in our corporate and regulatory practice, and suffice to say, the right person to guide us on this topic. With that, I would like to now invite Moin to present. Over to you, Moin.
Thank you very much, Purti. Good evening and good afternoon, ladies and gentlemen. So I'll begin with a story um, so that we understand what we are going to really discuss today. So a few years ago, there was an Indian entrepreneur, let's call him Arjun for now, who had a dream to transform the Indian agriculture using technology. And he developed an innovative platform to bring in a unique supply chain and create a special market for produce, both in India and internationally, across different states and remote areas. The business picked up really well. Arjun incorporated the holding company in Singapore just so that he's got better credibility and better access to investors. He got a very good valuation. It was almost $1 billion valuation. Some of the global investors lined up, and he then was having the a sort of more matured round of investment where a diligence was done, only to find out that the fact Arjun, as an Indian resident, controlled the company in Singapore, which had eventually set up a company in India for actual operations, it was an issue which is a round-tripping issue from an exchange control perspective. And this put Arjun in a spot because he had two options. One was to walk away from a structure where he had created such kind of value, which would have shaken investor confidence, future prospects of the company. And the second option was that he divest his shareholding into a company and regularize his investments. But as it always happens for startups, while the valuation had really soared, in effect, he'd not cashed out due to the tax implications, and he also would have had a liquidity issue in doing a swap transaction, basically transferring his own holding into a company controlled by him in India. So this really highlights how important it is to understand the foreign exchange implications while setting up any business, investing into India, or having any structures created into India, and which is what we're really going to discuss today. To summarize, we'll start off by talking about some of the popular sectors of investment, and we'll do this because there is already a session that is available on our YouTube channel where my partner Atul has spoken about entry options, sectoral conditions, approval and general permission. So we'll focus and get into more details on some of these aspects and try and deal with how a life cycle of an investment would generally work. Essentially, you would have to cover, today we will cover sectors of investments. We'll also see how deals are structured, what are the possible corporate actions that you really will be exposed to as an investor, how you will exit, and what happens if there has been an inadvertent delay. Next slide, please. Now, speaking of sectors, one of the key sectors I can think of is single brand retail, because there is already an expectation that it will grow to about USD 1.1 trillion by 2027 and 2 trillion by 2032. So given rapid urbanization, increasing disposable income, internet penetration, this is a sector that's important. We'll deal with single brand retail to start with, which is under the general permission, but it is conditional. And to summarize, really, the conditions are as follows. Basically, you can have only one brand under which you should sell this product globally. Your branding should have been done at the time of manufacturing. This branding, and it can be either owned or it can be licensed by an appropriate agreement from a global entity. You also have to ensure that you comply with the local sourcing requirements. Basically, you need to get 30% of your raw materials from medium and small scale enterprises or cottage industries. However, if you're looking at cutting edge technology, this could be waived, or you could be getting an extension for the initial years. Plus, you can start off with an e-commerce store and move on to a brick and mortar store in 2 years, really. So next slide, please. Moving from here, we talk about multi-brand retail. Now here, essentially, the entire investment will be under the approval route. It's allowed up to 51%. And multi-brand retail has been slightly protected as a sector because of the possible impact it could have on small traders, and thereby impact the employment it generates in smaller towns. So here the conditions are more restrictive. So your minimum inflow of investment should be about USD 100 million. 50% of this amount needs to be invested into back-end infrastructure. You have sourcing requirements here as well, so your procurement should be from MSMEs, and e-commerce really is not something you can do under this sector. And the last thing really is that if you are doing multi-brand retail, the only way to implement this is to comply these conditions, approach the government, seek an approval, and see the feasibility of these stores. Plus, your stores will only be opened in areas where there is a minimum population of 10 lakhs. So it won't be open anywhere, as per the past census records that are available. Now, speaking of retail, both multi-brand and single brand, today the most popular form, next slide please. The most popular form is by way of e-commerce. And we all know that culturally, it's more acceptable now to order online, return products, test those products. And therefore, we will talk a little bit about what's permitted when you're investing into this sector. So in summary, what is allowed is to create a marketplace model, which essentially means that you will provide a place where buyers and sellers can come together and complete their commercial transactions. You can provide logistical support, you can do payment collection, you can provide other facilities, but really the products cannot be owned by you. The entities who are vendors cannot be controlled by you. And some of the examples of these are Amazon, Flipkart, some of which are models which are marketplace models. So what is really important when you're looking at such a entity? The key function is that control should be not with the entity which is providing this platform. The question that comes up really is that why certain types of sellers show up when you search for a product. Is there a preference given, and why is that preference given? How do these sales, or Black Friday sales or Boxing Day sales and these types of sales, how do they really function? Is it a function of the vendors coming together? Is it a function of the marketplace telling the vendors to fix a certain type of price? Are there any sort of control arrangements? So to test this, the condition under the rules is that 25% of your purchase threshold should not be from a vendor where you or your associate has any control, or your group companies have any control really. We've seen a lot of crackdown in the end of November 2024, where raids were conducted in the offices of some of such platform providers. And what was tested is the quality and the types of contract they have with vendors to ascertain if there were shell entities or entities that were just namesake vendors, which were otherwise controlled by the e-commerce entities or the platform providers. And what could possibly be the impact? The impact is that if you were a model which was inventory based, essentially you're selling multiple brands, so you'll be a multi-brand retail, and which is something that's prohibited. And here I will also add that, really speaking, single brand retail entities which are selling a single brand with complying all the conditions I mentioned a few slides ago, they're allowed to undertake e-commerce activities, but not the multi-brand entities. Next slide, please. Another sector which really is important because it impacts the health and safety of the citizen, and it also brings in critical technology, is the pharmaceutical sector. Now here, greenfield 100% foreign direct investment is permitted. In the brownfield, which is if you're buying into an existing business, you're allowed to invest up to 74% under the automatic route, and beyond 74%, you require an approval. Now, there are a few conditions that you need to comply. Your non-compete clauses should be specifically approved by the government. You need to maintain a production level of the same production level, for 5 years, basis what was the production in the highest production in the last 3 years. You need to maintain the same R&D expenditure that you've been maintaining over the last 3 years. And in case of any technology transfer, you're required to inform the government really in advance. And you see, the idea here is to ensure that if you are taking over any pharmaceutical business, the access, the R&D, the technology is all protected, and the availability of the products is continually there so far as the for the end users. And moving really on from here, now that we've discussed some of these sectors, next slide please. Downstream investment really is an important aspect, and what we mean by downstream investment is that, let's say I'm not doing a foreign direct investment into India. I'm using an entity where I already have shareholding beyond 50% or a control either contractually or otherwise through the board. And this entity is now investing into another Indian business. Same conditions that would apply to any sort of investments from abroad will apply. So your pricing guidelines would apply. There is a downstream investment reporting that will apply. Your sectoral conditions will apply. One of the issues that we used to see over a few years, and that got really tapped by the government eventually, is how does deferral arrangements work in the context of a downstream investment? And what this essentially meant is that there were two views here. One view was that ultimately this is an Indian company which is either foreign owned or foreign controlled, and therefore why should deferral arrangements apply at all? I should be able to do any type of deferral possible. Now I will speak about this in more detail, but deferral about up to 18 months and 25% is permitted. And the question really was that, is this available to foreign owned and controlled, or there is no limit applicable at all? There were three phases. First phase, people thought there's no limit applicable. They got questioned by the regulator, and the regulator took a more stricter view, saying that you can't even do it for 18 months or 25%, which was slightly absurd in a way, and therefore representations were made. And today there has been clarification that as long as you're complying with the 18 months and 25% threshold, deferral is allowed and available to foreign owned or controlled entities as well. What is really important in these investments is to check and test all the compliances, because an authorized dealer will not generally be involved, and only when you do your downstream investment reporting will you be questioned. So you need to check this and get appropriate advice already. There are a variety of readings and questions on how reportings need to be done. So that is also another thing that you should check and comply. There are questions on whether two foreign-owned or controlled entities, how their reportings and pricing will apply because they are treated as non-residents. This is also something I lean more on the conservative side. So you need to see because ultimately it's also an Indian company. And another question that comes up all the time is that can this foreign-owned or controlled company or FOCCs as we call it, lend money and borrow money in India? The answer is yes. This whole regulatory fiction is created only for the purposes of testing FDI both directly and indirectly into India. It's not applicable for debt related investment. However, whenever such foreign owned entity is doing any fresh investment, it should be either out of surplus earned in India, which is tax paid surplus, or through fresh infusion. They cannot borrow in India to make investments. Next slide, please. Now, in moving on to a very important aspect of an approval requirement, which applies irrespective of the type of sector, type of investments, etc., really is the press note 3. So, in about April 2020, there was a trend that there were a lot of opportunistic buyouts into India. And while this has been dealt with in detail in the previous presentation available on our channel, I just want to touch upon a few recent trends that we've been seeing. So when there was such a opportunistic buyout, especially from bordering nations, the government wanted to protect the investors and protect the Indian targets, and hence they brought in this additional approval requirement, which was sector agnostic. Few things that were unclear was the beneficial ownership. So today the rule in summary is that any investment, whether directly or indirectly through a bordering nation, requires you to seek a prior approval, which is beyond sectoral conditions or otherwise. So even if it's an automatic route sector, you'll still need this approval. What is beneficial ownership is today still not known. Given the geopolitical challenges and situations we've seen unfolding over the last few weeks, we do see that a lot of investors are very, very concerned of what would be the outcome. How would this really be dealt with? How would these approvals be dealt with, especially if there are state-owned enterprises? And we've also seen that state-owned enterprises are slightly uncomfortable to share information and share documentation with the government. So a couple of different type of structures or different options are being evaluated. So assume you are doing an investment into India and India is, part of a global transaction and therefore this indirect impact is that investors are considering, completely disconnecting India. We're also seeing a trend on investments where there is a private equity investor investing into India, and there's one of their LPs who happens to be from a bordering nations. If that LP is not most important to the structure, or the GP is not from a bordering nation, they're trying to see if that LP can be moved into a parallel fund or a separate fund really can be used. We've also seen a very disturbing trend where some global transactions have already happened, and this has come to attention separately. And post facto approvals really are being obtained because sometimes you're unable to control how the global head office takes decisions on completing a larger deal, which does have an India exposure. So it's very important to test the exposure from a press note 3 perspective, test the exposure from any Indian securities regulations or from a competition commission. So all of that's important on any deal which is having an India connection really. We're also seeing that a lot of scrutiny and questions are being raised on regulated sectors. So here I will just give a brief update here that because there is no beneficial ownership threshold, usually people have taken comfort on 10% being the threshold. However, with regulated sectors, let's say pharma, where beyond 74 you need an approval, even below 10% exposure from bordering nations has been questioned. Now, next slide, please. Now that we have understood some of the sectors and the press note 3 approval requirement, one important aspect while making any investment is your deal structuring. And how will I invest? What is the best way to think of my exit? Can I have optionalities? What will be the pricing really? So to deal with that, the first question is, which instrument do I invest in? And equity is one of such instruments which is treated as foreign direct investment. The second instrument that you can invest in is a mandatorily convertible security, which is compulsorily convertible to equity. There are phases when pre 2007 we were even allowed to look at optional instruments, optionally convertible instruments, but that is not something that's available now. And hence your instrument should be compulsorily convertible. Any optionality gives it the color of debt. A couple of questions which we have faced is that what is the price of this? Because there have been exotic pricing uh, arrangements that have been entered into in the past. And the answer is that when you're investing in a convertible instrument, the pricing should be fixed upfront. So let's take an example. If an underlying equity share is, as per the pricing guidelines, is 100, then and your convertible entitles you to two such shares on the date of issuance, your price of your convertible will be 200 upfront. You cannot have linkage to future performance. You cannot have any future dependability on pricing. So then this needs to be fixed upfront. We have another question that we get all the time is that what happens if I update the terms of these instruments? We need to see what disclosures have been done and on a case-to-case basis decide whether you need to go to the Reserve Bank or not go to the Reserve Bank for updating on this change. Next slide, please. Another deal structuring mechanism that we see is to create a mechanism to either be able to buy out the existing shareholders or force them to buy your shares at a certain price. Now, this is put and call options. This has been allowed. There has been a lot of doubt on the permissibility of this, but this has been now allowed under general permission. However, there are a few conditions. You should have been holding the shares for at least a year before you exercise any such options. Your option should not come with any fixed, sort of a fixed price or fixed IRR, and your price, whenever you exercise the option, will be dependent on the current market price really. And lastly, all these optional clauses can be only undertaken if you have held the shares for 1 year, as I mentioned. So there were a lot of transactions which are legacy investments where we keep seeing these exit options being exercised today. And the question is that can I use any contractual arrangements where I agreed on a certain type of price or no? Answer is no. This has been tested in a well-known case where this matter reached all the way to courts, Reserve Bank, government. The answer was that no pricing relaxations. However, one could have other arrangements where damages can be expected in case of a breach or a sort of an inaction attributable to the other investor or the Indian investor really. Now moving on from here, we look at scenarios where there could be a potential liability in future. There could be a conditionality that could apply to us, maybe a tax litigation, maybe a possible litigation, or any sort of impact on the valuation which cannot be ascertained immediately. It could be an industry related impact. So there are escrow arrangements that are very important. What has been allowed now is that up to 25% in 18 months is the limit that you can have for your indemnification or any such escrow holdbacks. I mentioned about the same thing, and I'll just recap it, that this is available both for direct investors as well as foreign owned or controlled companies who are investing downstream. There are a lot of questions whether this can be extended or not extended. One example I can think of is that if there is a litigation on the escrow agreement itself and the money is not being able to be released, there could possibly be an extension. But apart from that, I don't really think this extension might work, especially because this is a policy and the policy has really laid out. the timeline. And lastly speaking, what about certain things that may take longer? What about possible financial, ratios that could entitle the Indian investor to a higher amount? How can I deal with that? So as long as you're paid as much as what the pricing guidelines provide, it's okay for you to have other earn-out mechanism, which can then, with approval, lead to additional payments to the Indian investor, really, or vice versa, as long as the pricing is in order. Now, moving from here, uh, what is most important really is the pricing guidelines. I spoke about it a few times when we were discussing our our option instruments, our put and call options, etc. And therefore, pricing is very simply laid out. We have, if you're buying shares from a resident, the minimum floor price is a price that is determined as per internationally acceptable pricing guidelines. On the so it can be so let's say the minimum price is 100, so that it's easy. For example, you can pay the resident 150, 170, but 100 is the floor price. On the other hand, if a resident is purchasing shares, or from a non-resident, then that 100 becomes the ceiling. So that is the maximum that you can pay, and you cannot pay anything beyond that amount. We've seen a lot of questions on whether this can be relaxed, how this can really function in the context of multiple classes, and whether there will. So there's really been no relaxation. The only relaxation possibly is that if you are investing or doing a transaction which involves, let's take an example of a mandatory tender offer. As a foreign investor, if you're buying shares in a listed company beyond a certain threshold, you are required to make a mandatory tender offer, and for that offer price to the public shareholders is determined as per the SEBI guidelines. That determined price can be as per SEBI guidelines and will not be affected by the FEMA rules, really. So that's the only time when there can be a carve out. And another situation could be rights issue, which we are going to discuss in the subsequent slides, really. Yeah. Now, after having spoken about escrow arrangements, as an investor, when you are invested into an entity, there would be scenarios where your corporate actions will get undertaken, and therefore you will be sort of subject to your shareholding may increase, decrease, and there'll be an impact on your shareholding, really. And say if you are invested in a compliant manner, duly reported, you will be entitled to receive shares at the same price. So one of such mechanisms is the rights issue, or bonus issue, where you receive additional shares. And in case of a rights issue, so long as the same price is offered to both resident and non-resident shareholders, you're entitled to receive the shares up to your entitlement, basis your shareholding. What has really been tapped, though, is that there is a concept of renunciation, and where someone who's entitled renounces in your favor. If that is happening, really, then beyond your entitlement, you will still be subject to really pricing guidelines. There's been a relaxation under the recent press note, where there has been grandfathering for existing shareholders, so long as your pre and post shareholding doesn't change. One overarching impact on all of these really is the press note 3 again. If you're receiving any further shares, press note 3 still becomes applicable. We've seen that example in the context of a listed company, where there were certain shareholders who were Indians who had moved to Hong Kong, taken up a job, and received shares in such transaction, and a post facto approval had to really be obtained, uh, because they were situated in a bordering nation. Next slide, please. A similar impact you could have is when there's a merger or an amalgamation, and you receive shares in a entity which is a transferee entity, or the resultant entity. Now, again, all the sectoral conditions and other conditionalities would apply. You could very well be paid out in cash if you're not eligible to continue to hold the shares as part of the scheme. And lastly, the press note 3 scenario will always be applicable. Here it is very relevant to mention that if you see the first example I gave when I started the presentation of an Indian having a holding structure out of Singapore move and so that he gets investments, that we've seen reverse flips happening, and we've done one such reverse flip with approvals in record time, almost 45 days, where with only regional director approval you'll be able to get the control back and merge your overseas controlling entity into your Indian subsidiary. The next slide, please. So we've had a good clarity on the structure, what are the deal structuring mechanisms and corporate actions. Now comes the question of exits, really. And when we talk of exits, it's very important to have a feasible and an enforceable arrangement in place, because I'll just recap a few things which I already discussed and move quickly here. One is your put and call option cannot have a fixed IRR. We discussed that in detail. Your pricing at the date of walking away will be the pricing that's applicable on the date when you're exercising that option. You can't have any exotic convertible arrangements. And I just want to mention about one example where a certain assured price was expected, and when the matter was the entity Docomo Tata Sons case, where the matter went for arbitration internationally, and what was really allowed to be paid was something that the parties agreed as damages, and there was no leeway really given so far as the price at which the transaction can be done was concerned. So we cannot have an arrangement where a non-resident says that if you've not performed a few conditions, I'll be able to buy you out at the zero value or a single dollar. It'll still be the fair market value. What you could potentially arrange and agree upon is having a sort of a damages arrangement, which could be for contractual breach, and that damages could then be paid for losses or breach that's attributable to the counterparty rate. Next slide, please. Now, a very, very sort of natural outcome of a very well controlled regime is possible delays. And I'll go back to on a lighter note, what Purti mentioned about that. The question the lawyers asked today is whether you reported in order your transaction or no. And what really happens if you haven't reported? And I'll just touch upon very briefly on possible sort of non-compliances that we've seen happen. So entry route conditions. Suppose you've not done a certain entry route compliance, you'll have to comply with that condition, approach the government or the Reserve Bank and get an approval, and then do a settlement with them. There could be a round tripping arrangement. For example, we spoke of the story where where Arjun had a company controlled out of Singapore. He was will have to now regularize it either by divesting his India connection from the foreign entity or getting an Indian entity to really invest into the foreign entity, and he transfers his holding to such Indian entity. Once that is done, he'll still have to go and settle regularize what's the non-compliance. Then we've seen pricing non-compliance, potentially not an actual non-compliance but contract. So you'll have to do your contract and ensure that it's in compliance really. If you've ended up investing in a prohibited sector, you have to unwind your investments really. And if you've got delayed compliances, you will do a delayed filing or reporting and get a late settlement fee really. Next slide, please. What we have, I did mention a few times in the previous slide that you'll do a settlement. So if you have done a non-compliance, you'll receive a show cause notice. You're exposed to almost 3 times of the contravention value, which is at the date of when this has been picked up or when it had been regularized. The other option you have is to approach the Reserve Bank of India for a settlement. And in cases where this is allowed by the enforcement authorities and where this is a inadvertent non-compliance, not involving money laundering or any serious offenses, you will be allowed to do that, where your exposure from 300% almost moves away to 10%. The process for this is online, very well streamlined, but the timeline is 180 days. What I've seen in transactions when I'm investing and a past non-compliance comes in, this is a possible solution that can be explored where delayed compliances are done and a compounding is filed, and one doesn't really necessarily need to wait for 180 days. but at least a structure is put in place with an escrow or otherwise, so that the compounding settlement fee can be taken care of. So I'll just summarize what we've discussed today. We've discussed the importance of adopting the right structure, ensuring compliance with the conditionalities, planning a contingency or an exit scenario in an enforceable way, and sort of also ensuring that you are having sufficient return or damages in place if there's a breach. So I hope this has been helpful. I'd like to sincerely thank you all for your time and attention. I'll be very happy to take questions that you really may have, and I will now pass on the control back to Purti. Purti, over to you. Thank you once again, everyone.
Thank you, Mohan, for that really interesting presentation. While you were speaking, the chat room has been abuzz with a lot of questions. I see over 20 of them already, but I think we'll just try to pick up as we go along, as the time permits us. Mohan, the first one for you is, does PN3 approval apply in case of passive increase in Chinese shareholding due to a corporate action of a company? Understanding the question would be like, if the company does a merger, demerger, or that leads to increase in share capital of a Chinese investor, does an approval apply in that case? And if the case changes, if it's a listed company that we are speaking of.
Yeah, I think, thank you, Purti. And as I mentioned, that Press Note 3 doesn't have any safe harbors or exemptions really. And it is sector agnostic. So it's not dependent on what sector you're investing in, or whether there's conditions or whether you sought an approval or not. This is an additional approval requirement. And even if there's a passive increase in your shareholding, and which could be uh, by virtue of a buyback of shares, or if you exercise, sort of any convertible instrument, or if you have sort of been issued additional shares,
Hmm.
anything that leads to you getting new shares in a merger, in a, whatever the case may be, this will really require an additional approval, a separate press note 3 approval. And we've seen an example where a very well-known large listed company did an issuance of shares, and they saw their beneficial position of shareholders, all Indian names. They assumed everything was in order, only to find out at the reporting stage, the Reserve Bank highlighted that there were some shareholders who were situated in Hong Kong, which essentially meant they were residents who had taken a job there. Uh, they had to go for a post facto approval. A second scenario was one of the Indian residents moved on to Hong Kong and got a Hong Kong passport. He swapped his foreign company shares for an Indian business and received shares in India by virtue of swap. Again, he was asked to obtain a post facto approval.
Essentially, all cute pathways lead to RBI's approval when it comes to the PN3 compliance. More, the next question is, we all know that rights issue is just a matter of a board approving the price, and the issue happens at that price. When it comes to FEMA, essentially a non-resident investor who's going to benefit from such a rights issue, is that allowed if the price approved by the board is below the fair market value?
So, rights issue, the condition that one needs to ensure and comply is that you need to offer the same price to all shareholders. And here again, we need to see the type of transaction really, where there's parity offered to all shareholders. Another thing that has been attempted to be plugged, especially in the case of listed deals or otherwise, is that renunciation of shares, where you are allowed to renounce your entitlement to in favor of another shareholder. And if that is really happening, Purti, we'll have to check. Otherwise, the pricing is possible to be lower than the price that is calculated as per fair market value only in case of rights issues, because there is parity offered to all shareholders at once.
Moin, I think you did discuss business activities and structural requirements, depending on the sector that you are investing in.
Right,
One of the questions
right.
seems to be, and this is something I think we commonly face also from clients, surprisingly, it may sound very vanilla, but how do you determine the business activities of an entity, assuming the entity is into multiple businesses that they are investing in, to evaluate the sectoral conditions? Do you have any
I
tips or
think,
suggestions? That's the
right,
question.
there'll be a twofold approach to my mind, Purti, in this case. One
Hmm.
is looking at your charter documents,
Hmm.
which lay out your main objectives. and the businesses that you're entitled to as a company to carry out. Beyond that, we also need to look at the financials to ascertain what's the revenue stream really. Let's take an example. A company says I was set up for manufacturing, but all they've been doing over the last 2 years is investing their money into mutual funds or listed stocks and earning substantial profits, and therefore meeting the 50-50 test of financial assets and financial income and qualifying as a financial services business. So it's a twofold test. One is you look at the charter documents, look at what objects they can carry out, and also see in real life what they've been doing and how revenue has been generating. There could be transitionary phases where new business will take time and they would deploy money in liquid funds, but uh, it has to be case to case analyzed really.
I think essentially the answer remains that do reach out to the right advisors when you decide a business that you're
That is
investing in
possible.
before deciding whether the conditions apply or not. Fair. So Moin, you did discuss that retail is the most interesting sector right now in India, and if I may say so, one of the hottest sectors right now in India, where we are seeing a lot of business activities. But the question is, what are your views on fast retail platforms? While we do have access to several such platforms, I think I'm assuming the audience is buying from using those platforms as a consumer as well. How do they typically operate, and do they follow an inventory based model or a platform based model, and hence is FDI permitted? What is your observation on these sectors?
I would, thanks, Purvi. And I would think that there are two ways to function in this mode. One is if you are a foreign direct invested entity or FDI entity, you will still have to follow all the conditions that are applicable to a marketplace model. Even if you are doing fast retail, what you are essentially doing is giving a faster logistical support, probably
Hmm.
having some kind of a storage or warehouse which could be a dark store where you're holding on to products of the vendors so you can quickly pass it on when there's an order. One will also need to ensure that no control is visible or control is created so far as vendors is concerned. Sourcing will have to be distributed enough. What one more thing that is possible is that suppose you have an Indian entity where you have invested, but you don't control that entity. So let's say we have an Indian business which is very, very well established, uh, you know, e-commerce platform or some, a kind of an application, and they do fast retail through their subsidiary.
Hmm.
Now, because I, as the Indian entity with FDI, am not controlled or owned more than 51% by a foreign resident, what I do downstream is not treated as foreign direct investment. And then in that situation, I'm free to even use an inventory based model. So these are the two
Hmm.
ways I think this could really be done. But if you are using an FDI entity or you have exposure from foreign investors, you will have to ensure that it is a marketplace model. There is no separate
Only
exemption
market.
for fast retail. Yeah.
Fair. Moin, there is another question related to the retail sector, so I'll just play with it while we continue these questions.
Sure.
The question
Sure.
remains, and this seems a very personal question. If I manufacture and sell my own products through a store, would this activity be classified as manufacturing or retail? We all get this question, but I would like you to pick this up. And then,
Yeah.
interestingly, whether answer changes if manufacturing was outsourced to a contract manufacturer. Unless essentially I get it contract manufactured and then sell it directly in stores. And of course, if I have retail, so what is my business category then? Am I a manufacturer or am I a retailer?
Now, if you are manufacturing your own goods
Hmm.
and you're selling those goods, your business is that of a manufacturer. You will not be construed as a retail outlet or a retail business because you're selling your own product which you have manufactured. Whether you use a contract manufacturer or you do the manufacturing yourself, I don't really see any differential treatment. But the branding of your product should be done at the stage of contract manufacturing itself. It can't be, and this I have seen I want to share an example. In
Ah,
the precious gems or jewelry market, there's a model where people tend to create designs and then they sell those products across retailers, across brands. That is a problem area because then
hmm.
you are buying something created by someone, not necessarily for yourself, and there's no exclusivity really. But on the other hand, if you're a large brand and you are manufacturing, designing, branding, and selling, then there is no issue really. So one needs to see whether this is genuine manufacturing, and especially in contract manufacturing, whether it is exclusive contract manufacturing and branding done for you, or is it just a contract manufacturer who creates the products and goes and sells to 20 other outlets. Then that can become a slight distinction and could be leaning more towards single brand retail.
Mm. Fair. Quite a few structures are harbored around this manufacturing versus retail criteria. So I think
Right.
we are fairly aligned on this position. Now, the next is again a sector related question. So I'll just stick with the flow, but now we are moving to pharma instead of retail. The question is, are medical devices considered part of pharmaceutical sector? Or do they fall under the liberalized FDI regime that is applicable to manufacturing instead of pharmaceutical? What are your views on that?
I think you're Purti, 100% FDA is permitted on medical units, and you're right. They could generally also fall around, manufacturing sector, because you're the one who's creating these devices yourself. But it's also called out in the FDI rules that 100% FDI is permitted in the medical devices sector. Really.
Hmm. Fair. Now, moving on to the whole downstream bit that you discussed, there's a question related to that as well. Can an Indian company with FDI, which is owned and controlled by Indian residents, so essentially not an FOCC, make downstream investments in the multi brand retail sector? And would this require a prior government approval?
This is also a question around which so many structures function. And if I heard you correctly, Purti, you said this is a entity with FDI, but it is not
I
owned and controlled by foreigners,
Correct. It's
right?
IOCC. Yes, correct.
It's an IOC. So it's an Indian owned and controlled
Correct.
entity.
With that, yeah.
Indian owned and controlled entity, though it has some FDI into it, it can do downstream investments in any sector because it's not treated as a downstream foreign direct investment. It can
Hmm.
invest in prohibited sectors, it can have inventory based e-commerce models, it can do multi-brand retail, anything it wants to do because it's treated as an Indian investing into another Indian business where all these sectoral conditions won't apply. Obviously,
Hmm.
licensing and other conditionalities will apply, and that will have to be respected.
Fair. Now, this I'm not sure when the question is too broad and how much can we really answer without getting too technical here. But I think the question is very simple, but as complex as it gets. From an FDI standpoint, what constitutes control? Your favorite question. I'm sure we're all dealing with it on a day-to-day
I
basis.
think
What decides control?
the question really is the control is very interesting, is defined in different ways in the foreign exchange rules in different contexts. But
Hmm.
uh, if we are talking about, let's try to correlate it to some sectors, let's say. So I think if you're able to control majority shareholding, if you're able to control how the directors function, how the board functions, and how the majority policy decisions are made, you will be in control. Now, I'll give you a few examples where this has become relevant. Retail, we spoke of e-commerce and we spoke of inventory-based models. If you're able to control policy decisions of your vendors, if you're able to control more than 50% shareholding, obviously, then you are not a marketplace model anymore. Same way, if you are trying to, invest through an indirect structure, a downstream structure, question of control becomes very, very relevant, really, because if you either have control or ownership as a foreigner, it becomes a FOCC. So the distinction really is Indian owned and Indian controlled, really. Now,
Hmm.
this concept of control has been discussed in variety of forums. It's been attempted to be dealt with at the Supreme Court as well in Shubham Ventures case, but there's been bright line test discussion papers. So, in summary, one cannot give a straight answer, and that's intentionally the way it is kept so that the lawmakers and the enforcement authorities have flexibility. One needs to test the substance really. Now, what in my view is not control are certain protective rights that an investor as a minority shareholder might have, which is some kind of affirmative rights which don't really affect the day-to-day functioning or the majority policy decisions, but protect your rights as an investor and your capital that you've invested. Really.
Thanks, Moin. Moin, the next one seems to be some creative mind who's exploring a very, very interesting option. The question is,
Right.
how does PN3 apply to individuals born in a restricted company but now holding citizenship of another country? Essentially, assuming it's a Chinese-born individual who now holds a British passport, and a vice versa, an Indian-born resident suddenly holding a Hong Kong passport or a Chinese passport. How does that apply? The PN3 restriction apply in these both cases? Chinese to
Yeah. On
British and Indian to Hong Kong.
on the first one, question is substance and residency.
Yeah.
Because the lawmakers also very smartly mentioned two things when we deal with the PN3 applicability. First thing was that whether you are a citizen of a bordering nation, so that clearly is not happening because he's a British citizen now,
Ah,
which he could have obtained with investment or otherwise in future. The second conditionality is situated. If your residency is also outside and
hmm,
your passport is also of another country, then as on this date, you're not treated as a citizen of,
India.
the bordering nation. If I was a regulator or an enforcement officer, I would also test the actual timeline for which the person has held British passport. What is the source of funds? Whether there are any indirect arrangements. So it's very timely to talk about some sort of a VI arrangement. We saw this happening a few times, but essentially means that I am a French national. I invest into a fund which invests into an Indian company. If you ask me whether Fresh Note 3 will apply, answer will be no because it's a French national, right?
Correct.
But
Yes.
that French national enters into a arrangement and obtain debt from a bordering nation and
Hmm.
let's say Hong Kong and gives all controlling rights to that lender. So essentially, what you have ended up doing is that you're indirectly being controlled by a vendor from a bordering nation. Your source of funds is also from there. So first answer to summarize, if your British passport situated outside, everything is in order, substance is met, no problem. You are treated outside PNC. Indian resident, and I gave this example when I spoke, who has taken a Hong Kong passport, no matter that your money comes from India, you remit it from India under your non-resident ordinary account, doesn't matter. The fact that you are
Hmm.
holding a passport of Hong Kong, all your investments now under FDI route will be subject to, press note 3 compliance.
It's always interesting and fascinating to me how this circular, which is barely like 5 or 6 years old now, has led to so much creative thinking at both ends, lawyers, advisors, clients, from all ends. The next question, I think we have a lot of PNG related questions. We'll try to cover as much as we can during this session. The next one is,
Right,
how is PNG applicability assessed in the case of investments made by private equity shareholders? One of the favorite questions that we deal with in real life as
right,
well.
right. So, so I think, see, we'll start with what is theory and how in practice it is functioning. See, law does not give any threshold. Law says any beneficial ownership. Now, especially in the context of any private equity investment fund, there'll be an LPGP structure. So if you're limited partners, anyone is from the bordering nation, technically you would be exposed. But that may not practically work, and therefore, how the industry is looked at is that if 10% or more LPs are from bordering nations, then we will consider it as a threshold being met. If a GP, which is a general partner or controlling shareholder, is from a bordering nation, then also you will consider that press note 3 is applicable to you. Now, in practice, what's happening is that if it is an unregulated sector, which is an automatic route general permission sector, then 10% threshold is functioning. If it is a pharma sector or sector where part approval, part automatic is there, and you're going to cross the threshold and go to government, then and prior approval is being suggested even if the LPs are less than 10%. So I think that's really the way things are functioning. But if you ask me technically, there is no threshold really prescribed. As long as there is exposure, you have to go for approval, and therefore some more conservative funds are also disconnecting the exposure of LPs from the bottom.
Yeah, sticking to the PN3 curiosity and theme, how does the PN3 apply to investments from foreign listed companies, given that their shareholder base is changing constantly? Essentially, if it's a company listed on LSE, it may there is always a position or always a situation possible that there'll be some investor out of a bordering country who has invested in this listed company or acquired shares on LSE directly. How do you deal with that? How does the test apply in that case?
Again, there is no exemption that's available, but
Hmm.
practically on the date of investment, the BENPOS is really checked and the list of substantial shareholders who are in control is checked. Because if there is a certain shareholder on the date or the following day, there can't be multiple approval applications because you also need a lot of details of such investors. And I don't think any public shareholder will be willing to share the details, but technically there is no exemption today provided. But the way things function is to check the BENPOS and check the list of majority and substantial shareholders, like akin to what we call promoters in India, and take a decision on how to move forward.
Again, the theme does continue: take the right advice at the right time rather than regretting later. With that,
Right.
Moin, we'll have to wrap up the Q&A. There
Yeah.
at least 15 more questions I can see, but unfortunately, time is of essence and we need to wrap up this schedule as well. So, with that, I would like to thank Moin for sharing his expertise and experience with us today. I thought he did an outstanding job. Thank you so much, Moin. After the
Thank you.
webinar, we will send you, thank you. We'll send to you a copy of today's presentations, material summary notes, and a link to the webinar recording. You will also separately receive a request for your feedback on the webinar. Please do take some time to send us your feedback, comments, criticisms, and hopefully some compliments. The form takes less than 1 minute to complete. Thank you for your attendance today, and we look forward to being with you again at the future Investing in India programs.